Now we get to talk about the coinsurance and insurance to value clause here. What happens here is that there is a situation in which some insureds decide that they don't want to keep the proper amount of insurance on the policy. So they're not keeping the replacement cost value amount there. So this allows for owners to reduce the amount that they are covering on the policy less than the replacement cost value. But what this does is it puts a line in the sand to where if you don't have the proper amount of insurance as determined by the coinsurance for the property, you will end up having to suffer a penalty on any partial losses on that property. So what we're talking about is, let's just say you've got a replacement cost value of $200,000 for a house. And the $200,000 is how much you should have on there so that if the thing completely burnt down, that you would be able to replace and rebuild that house. But the insurance company typically is going to put down a 80% coinsurance ratio on there, meaning that you're going to have to keep at least $160,000 of insurance on the property. Otherwise, any partial loss would be subject to this next formula that we're going to discuss. Now, to determine how much insurance you should have had on there, you just multiply the replacement cost value times the coinsurance. It's just a multiplication. 80% times the 200,000 gets you the 160,000. So the formula to reduce the payment in the case where the amount of insurance that you did keep on the policy is less than the amount that you should have, you would take the amount of insurance that you did keep on the policy divided by the amount of insurance that you should have kept on the policy, multiply that by the loss, and of course subtract out the deductible, and that would be the payment in the case of a partial loss where your amount of insurance was less than what you should have had on the policy. So an example that we have here is going to be John owning a home with a replacement cost of $100,000 for which he did insure it for $40,000 with a $1,000 deductible and an 80% coinsurance clause. He suffers a $40,000 loss. They're asking in this case, how much will he be paid? Well, of course, he can't be paid out $40,000, even though that is the maximum amount of insurance that he's got on there, because this is a partial loss and they will suffer a penalty in this case. So the first thing we do is we take the $100,000 times the 80% to create what we should have had on the insurance. So that we calculate the should first, and this comes out to $80,000. Now we take the $40,000 divided by the $80,000. We multiply that by the $40,000 loss and subtract out $1,000, which down will calculate out $19,000 of payment to John in this loss situation. Second example here, just so you know, if there was a total loss on that case, $100,000 would be the loss, but the amount paid out would be the maximum that could be paid out. So a total loss would be up to the maximum, which would pay out to $40,000. Now, question 5, the insured purchased $100,000 of insurance on a building with a replacement cost of $250,000. The policy has a minimum coinsurance of 80% requirement and a $1,000 deductible. If the insured had a $120,000 loss, how much will the company pay? So this is not the proper amount of insurance, but we can figure that out real quick. How much insurance should this insured have had? You would take the $250,000 times the 80%, which comes out to $200,000. And clearly the $100,000 is not equal to $200,000, it's much less, and therefore you would take and apply the formula. So $100,000 divided by $200,000 for the did and the should, multiplied by the loss of $120,000 minus the $1,000 deductible. In this case, $59,000 is what it comes out to, and that's answer C. One thing to note about all property policies is that these property policies will have no benefit to a bailee. That's somebody that has property in another's care, custody, or control. Typically, bailee coverage or exposure is going to be associated with a situation where you've got, a business need right? So a lot of examples of Bailees are going to be dry cleaners, repair shops of, shoes, autos, whatever it is, TVs. So you're basically having something held for a special purpose and then returned. And while it's in your care, custody, and control, if something happens to it, you're responsible for it. That's where you would need Bailee coverage, and there is no benefit to a Bailee in property policies. So it is excluded. Cancellation on all property policies is going to be requiring a 10-day written notice within the first 60 days of underwriting, and then all other reasons why you would potentially have a middle of the term insurance company dropping your policy or canceling your policy would be things like if there was any fraud, or if there was an increase in the hazard, or if the insurance company was having financial troubles with either reinsurance or becoming financially impaired, because the Texas Department of Insurance will require it. Also, on a non-renewal, if the insurance company doesn't want to renew your property policy, they will have to give you a 30-day notice prior to that non-renewal. Now, if the insurance company decides that they want to do something that is better for the insured, they are not required to physically change the policy if it's to the betterment of the insured. This is through what we call the liberalization clause, so they can automatically apply this to the policy without having to physically endorse to the policy. The death of a insured under a property policy does not stop the policy. In this case, the legal representative becomes an insured so that the property can be properly adjudicated after the person's death. Endorsements are going to be any written waiver or change of a policy provision. These are going to have to be done in writing by the insurer, typically by an underwriter. In property policies, there is a possibility that you have some of your property stolen, and you do have, as the insured, what we call the recovered property option. That means that if the insurer has already paid you out a payment, you have the option to take the property back or keep the money that they gave you. In the case that you keep the money, they just have to have you sign over ownership or title to the property. And in the case that you take the property back, you have to return the money, right? Obviously, you can't do both. One thing here under the mortgage clause, just understand that nothing that the insured does in this case will impair the rights of the mortgagee, and the mortgagee will have the same rights as the insured, right? So an example here would be the insured borrowed money to purchase a building and then tried to set it on fire to collect the insurance, but the arson was discovered and the claim was denied. But the mortgagee, the bank, right, will still be paid what it was owed, right? So just because there was something illegal there and they couldn't pay that out doesn't mean that the bank cannot be recompensed in that situation. Loss payable clause is going to be something that also is something out there for if the declarations page is showing a loss payee, they will be considered an insured, and therefore they're going to require a notice of cancellation or non-renewal. Concept that we need to understand here that comes up on the test periodically is liquidated demand. This is in the case of a total loss by only the single peril of fire. So it has to be a total loss by fire only. In these cases, these policies do not suffer a deductible, right? So the full amount of coverage is paid out and no deductible is applied. Another name for this would be called a valued policy. All right, some exclusions on the property policies. So the first one's going to be what we call ordinance or law. Typically, this applies to what we call building codes, right? So if you say had a building that was built back in the 30s, that was before insulated electrical wire was used, they would call that 3-wire. These are exposed wires. And new laws require that those be updated to insulated wires for fire safety hazards. And so because of that, that can be a pretty significant increase in cost. But these things can happen all the time. But generally, property policies will exclude the ordinance or law updates, and they will only compense you back to the actual cost. They won't pay for the upgrades or the new updates to the building code updates there. Also, typically the property policies will not cover earth movement. This includes land shock waves, earthquakes associated with either volcanic action or landslides, mudflow, sinking, rising, shifting, mudslides, or sinkholes. Water damage is also typically not covered under property policies. This is including damage caused by flood, sewer backup, or other types of water damage. Now, under both earth movement and water damage, just because these are typically excluded under property policies as a standard doesn't mean that they can't be changed here. There are common endorsements that you can get for earthquake and for flood and sewer backup that you can put onto a policy to have those things covered. Power failure in this case is going to be defined as as any utility service that occurs off-site of the location and causes damage on the property or causes some kind of a loss. That peril will not able to be covered under property policies. Generally, neglect is never going to be able to be covered under insurance, and this is because if at the time of the loss further damages because of the insured's neglecting to try and save or preserve the property, there is no coverage for the additional loss or damage. This is also reinforced under the conditions, but it's also listed under the exclusions as a separate exclusion of neglect. Governmental action is going to be excluded. This is referring to either the destruction, confiscation, or seizure of property by order of the government. The one thing that will always be covered in this case would be a fire. Nuclear hazards are too large of an exposures, as are wars, insurrections, rebellions, and revolutions. Damages due to those causes will be excluded from personal property policies, as well as commercial property policies. And of course, intentional losses. So no policies out there will cover intentional losses. There's only some limited amount of personal liability policies, professional liability policies that might cover some limited amount of intentional losses. But for the most part, if you are committing or directing another to commit an intentional act that causes the loss, unfortunately, that cannot be covered under the insurance policy. All right, so now we've got some questions we're going to go over, a review on Chapter 5. First question we got here is the insured's roof is damaged in a hailstorm. The insurance company asks the insured to cover the holes so that the rain will not get in and further damage the property. This is an example of what policy condition? A, appraisal. B, abandonment. C, duties after loss. Or D, duty to defend. So of course, this is going to be under the C, duties to after the loss. Number 2, which of the following statements about a mortgagee's rights under a property form is not correct? So 3 of these should be correct, 1 should not be correct. A, no act by the insured will jeopardize the mortgagee's rights. B, the mortgagee may file a proof of loss if the insured fails to do so. C, the insured is or mortgagee is entitled to the prior notice of a policy cancellation. Or D, the mortgagee may abandon the insured property to the insurance company. Well, the insured can't do this, neither can the mortgagee. D, the mortgagee cannot abandon the insured's property to the insurance company. Number 3, Bob is purchasing a homeowner's policy to cover a home costing $200,000 to rebuild. The policy contains an 80% coinsurance clause. In order to avoid the coinsurance penalty in the event of a partial loss, Bob should purchase the policy with minimum limits of at least how much? A, $200,000, B, $180,000, C, $160,000, or D, $40,000. So in this case, we are just asked to calculate the should, how much insurance should Bob have? And in this case, it's 80% times 200,000, which is C, $160,000. Number 4, one of a set of a dozen antique crystal glasses was damaged in a covered loss. The set had been valued at $1,800, but now are only worth half of that. How much was the loss? A, $150, B, $600, C, $400, or D, $900. In this case, half of $1,800 is $900. That's going to be the value, but also the loss. And they're asking for the loss. This is D, $900. Number 5, how much time does an insured have to bring a suit against his insurance company in the state of Texas after meeting all the policy conditions? Is it A, 1 year, B, 2 years, C, 3 years and a day, or D, 2 years and a day? The correct time frame here is D, 2 years and a day. Number 6, actual cash value is defined as A, what you can sell it for, B, what you can buy it for, C, what it is worth after depreciation is taken from what it costs today, or D, what it is worth after an appraisal. The definition of actual cash value is C, what it is worth after depreciation is taken from what it costs today. Number 7, how soon after the proof of loss is filed with the insurance company in Texas must it pay you? A, 60 days, B, 30 days, C, 15 days, or D, 91 days. So in Texas, this is going to be A, 60 days. For the dwelling, number 8, liquidated demand provision requires the insurer do what? A, to pay the full face value of the policy in the event of a total loss. B, to pay the claim when the insured demands it. C, to pay the full amount of the policy for a windstorm loss. Or D, to pay the total amount of the insured on the structure for a total fire loss. The answer here is going to be D, to pay the total amount of insured on the structure for a total fire loss, right? Remember, total loss due to the peril of fire only for liquidated demand. Number 9, Dora insured her home for $50,000, even though the cost to replace is $250,000. She suffered a $40,000 fire loss, and she has an 80% coinsurance requirement. How much will the insurer pay Dora, assuming that no deductible applies? So first we have to factor in what is the amount of insurance that she should have had on there. So this is going to be $250,000 times 80%, which is $200,000. The did in this case is $50,000 divided by that $200,000, which is going to be 1/4 or 25%. And that is going to be multiplied against the $40,000 fire loss, which is $10,000. And since in this case, they're asking you not to apply any deductible, there would be 0 there. So the payout in theory to Dora would be $10,000 C. Number 10, when a regulating authority requires the damaged property be replaced at a new building code standard, which increases the original cost, these costs are excluded. What is the name of the exclusion? A, replacement value or law, B, an ordinance or law, C, actual cash value or law, or D, ordinance or codes. In this case, the correct answer is going to be B, ordinance or law. That is the correct name for that exclusion. And that concludes Chapter 5, Property Policies.